You're watching Silver News Daily. Subscribe for more.
So I think the real shocker here will be silver, not so much gold. Yes, gold has gone into price acceleration while silver's built this pattern on momentum that says
The gold and silver markets are flashing a signal so loud, so undeniable, that only the blind could miss it. Right now, the gold to silver ratio, the heartbeat of the precious metals market, is collapsing, and history tells us what happens next. Every time we've seen this signal before, silver hasn't just moved. It's exploded, delivering life-changing gains to those who acted early. But here's the thing. The mainstream isn't talking about it. The media's silent. The big banks are playing it cool. But behind the scenes, smart money is moving fast. This isn't just another rally. This is shaping up to be the biggest silver surge in decades, and those who wait could end up chasing prices far higher than they ever imagined. So, buckle up, because by the end of this discussion, you'll understand exactly why silver is about to leave the launch pad, and why now is the moment to pay attention.
I think it's in a briefer corrective process than we've seen prior to this. Over the last year, for example, if you'll look at what gold did, it moved up in layers and sometimes would be stuck in a horizontal zone for a handful of months. Go back to April of 24, for example. We said in March of 24, expect the beginning of the bull market again. In other words, it's been asleep for 3 years. And it's sure enough, it engaged, but it still had these layered, time-consuming zones of nothing, where we just simply hold and absorb the selling and finally can go up again. Well, right now we're in the second week of a pullback period. So in fact, it's not even a full 2 weeks because, anyway, the number of days is a handful. And I suspect this will be brief. It won't be multi-month. I don't think we're going to correct like everybody seems to think. We're going down to 2,800. I think what people are doing, our price chart is primarily, is when they project, it's all over for now, we got to go back down to here. Every time they do that, what they're doing is they're finding the prior shelf of highs that was broken through, and then you get a surge, and they seem to insist that you must go back to that prior high to test the price high. And gold hasn't done that. Instead, it's pulled back, but never gone back to the prior high. And right now, the assumption is, we're going to have to drop $500 from the high to get down to 2,800. And, it's going to take a long time, et cetera, et cetera. And this derails people emotionally and out of a lot of them get out of their positions. And we made a point of that in the last weekend report. We showed, I think it was 2010, 11 phase in the gold bull market then, where we were in the acceleration phase. And we circled all the times where you had these scary downside breaks and or congestion zones. And we posed a question at each of the breaks. We said, you got out, but did you get back in? Because usually, boom, if you weren't really precise, if you got out, you didn't get back.
The gold to silver ratio isn't just another technical chart. It's one of the most powerful predictors in the entire precious metals market. And right now, it's flashing a rare and urgent warning. Historically, whenever this ratio collapses after hitting extreme highs, silver doesn't just follow gold's rise, it catapults upward with breathtaking speed. Think back to 1980, when the ratio plunged and silver shot from under $6 to nearly $50 almost overnight. Or 2011, when a collapsing ratio propelled silver from $9 to nearly $50 again, outpacing gold's gains by a massive margin. Today, we're staring down a similar setup, with the ratio finally starting to crack after stretching to unsustainable levels. And just like before, when this rubber band snaps, silver has a habit of violently overcorrecting, leaving those who hesitate scrambling to catch up. The lesson from history is clear. When the gold to silver ratio breaks down, silver doesn't walk. It runs, and it runs hard.
Back in, unless it made a new high again, in which case you missed a chunk. You get the point. I think that's where we are. Silver's the wild child. when gold had a mild little pullback during that stock market break in the first week of April, silver had a huge break. You know, it went from $35 to $27.50, much of that occurring in 2.5 trading days. And so if you look at a silver price chart, you wiped out the prior major low in December, which had halted. It had dropped from 35 down to just above 30, went back up to 35 by March of this year, and then puked through that low like it was the end of the world. And in a heartbeat, it went from 27.50 up to like 30.5, 31, 32, 33, and right now we're trading in the 32s. I suspect this sell-off doesn't have much more time in days and or price, and that we can see when we look at momentum, whether we're looking at real short-term silver gold momentum like day-to-day type momentum action, or looking at some bigger pictures, it looks like it's a setup for another surge. In other words, we're just having another pullback. And I don't think silver is going to have another puke. You don't generally have two of them. In other words, if you had one that washed everything out and immediately slingshotted back up into normalcy, you don't do it again. You've had your cleansing. So any people expecting a duplicate cleansing, I think they're wasting their time. Anyway, that's where I think we are. I think we'll come up out of here pretty shortly, and there are some structures overhead on momentum and even on price that say you get back up 34, 35 on silver again, watch out. You could really blow at that point upside. Yeah. Don't assume you've got to go back to a prior high. That assumption is not proved valid. And there's another assumption that's been kicked into the gutter, okay? I'm tired of hearing it. If the stock market goes down, gold and silver go down. Okay, well, if you look at what's happened over the last couple months, it's been totally opposite to that. Now, there was that one time where silver did puke with the stock market, but then it dusted itself off and said, you know what? I shouldn't have done this. So zoom, you're back up in the 32, 33 zone after being at 27.50. So it was a mistake on the part of those who sold. But gold didn't really flinch that much. And if you go back and look when the S&P made its highs, which would be like in January, in fact, we put out our first sell signal in the first week of January, and 2 weeks later, the market made a new high. S&P did marginally, and that was the top. Go back and look at what happened from gold through March, April, etc. Stock market from January through March, April, total opposites. And now, what's gold and silver doing over the last week or two? They're pulling back. What's the stock market doing? Rallying. So in other words, forget that notion going forward that we must move with the stock market.
Trade tensions that once weighed heavily on global markets are finally easing, and with that shift comes a tidal wave of optimism, the kind that fuels explosive moves in commodities like silver. Just recently, talks between U.S. and Chinese negotiators in Geneva set a new tone of cooperation. While hints from former President Trump about cutting tariffs have only added more fuel to the fire. In the wake of this new atmosphere, pro-cyclical sectors tied to growth have started to roar back to life, and silver, long seen as both a precious and industrial metal, is riding this wave of renewed confidence. Early May already delivered a 1.4% gain in the Bloomberg Commodities Index after a bruising April, and this shift is just getting started. Energy and industrial metals are catching bids. Gold is knocking on record highs, and silver is quietly positioning itself for a breakout that could catch the entire market off guard. When optimism floods into commodities, silver doesn't just participate. It thrives. And the signs of that next major move are already flashing right in front of us.
Yeah, that's the reality that generally prevails over time anyway. Not all the time, but to link the correlation between gold and an incident of a stock market sell-off back in October of 2008, for example, or the COVID sell-off in March of 2020, those are isolated, rare events. They're not norms. And so people make the mistake of remembering only those particular minor instances and treat it as a norm. And they should have learned over the last several months it's not the case. Gold will benefit from a stock market top. We've argued that all along. It hasn't waited for the top to go up. Obviously, it's been going up solidly for a year plus out of that prior range. And but when the stock market breaks, that changes the data points and also will change central bank policy in the Western world. And I think we'll start to see that with the Fed pretty soon. They got numbers today that allows them to twiddle their thumbs some more. Yesterday, they got numbers that weren't too great, GDP. But the unemployment number today was okay, so they can twiddle their thumbs. And I think they enjoy that because they definitely want to, shove it into Trump's lap so they can say, well, we came to the rescue. Like a month or two from now when they start cutting rates, they could claim, well, he did it. We're trying to rescue it. But anyway, that aside, they will liquefy events. When the stock market breaks and the data points go, they'll go berserk again. And what does that do? That just helps degrade the value of the money you have by increasing its quantity. And that's what ultimately drives gold over the long term.
Underneath the surface of this building, Silver's story is a hidden crisis that almost nobody is talking about. A severe and worsening supply crunch that could ignite prices like never before. Global silver production has been under relentless pressure for years, with major mining operations facing declining ore grades, rising costs, and stricter environmental regulations that are slowing new projects to a crawl. Meanwhile, demand from both industrial and investment sectors keeps climbing higher, eating away at already thin inventories. The Silver Institute recently reported consecutive years of market deficits, and 2025 is shaping up to be no different. Unlike gold, where recycled supply can flood the market during price spikes, silver recycling is limited because so much of it is used in tiny quantities across countless industrial applications, making it expensive and difficult to recover. In short, the world is consuming silver faster than it can be mined, and the market has been papering over this imbalance for years, with stockpiles that are now dangerously low. When these reserves run dry and physical shortages hit the headlines, silver could catapult with a ferocity that catches even seasoned investors completely off guard.
If you're not already out, which we would be, in January we said get out for the S&P, and in early March the NASDAQ 100 said get out, and they both puked. And we predicted a bounce point, and they went right down to our bounce point, just above 4,800 on the S&P, and at 16,500 on the NASDAQ 100, two levels that we had predicted prior to that puke that they would bounce from. And they have bounced. It's now been a month of bounce. Most of that bounce, by the way, occurred about 2 days after the low. If you recall, I think it was April 9th when Trump said, okay, we'll have a 90-day pause. The market exploded then, stock market. And we are now above that high, that rally high. But most of the action since then has been below that high until just recently we nudged out above it. And we've predicted that this rally high would reach certain levels as well. So we tried to predict where it would bounce from, done. And then where's it going to go up to? And today, for the first time, the S&P has gotten up to our number area that we suggest is likely zone of resistance. So we'll see. Watch the next few days and see what happens. I know they think the world is now pivoting on one single thing, and that's the China-U.S. trade stuff. And we argue that no, there's a far bigger problem here. That's merely a provoking item that helped reveal internal weakness, the weakness being the effects of the biggest bubble in stock market history, U.S. stock market history. And it's broken, and I think that ultimately you'll find excuses all the way down as to why it's going down. But the real reason is that it deserved to turn down. It was overdone. It was excessive. It created built-in errors, and those errors are being exposed. I think the highs are in I realize everybody is focused on this China-U.S. thing where there's talk now that maybe we'll talk. Okay, fine. And therefore, oh, everything's fine. That was just a mistake. Stock market made a mistake. It was a great buying opportunity. Long-term momentum argues no. That break did major long-term damage. And this rally is to be distrusted, regardless of what the headlines would be that caused that factor to occur. In fact, it started down and did a lot of the breakage before the tariff situation really began. So realize that as well. So yeah, we distrust the rally. I have no personal position in the stock market short, for example, even though I'm negative. And the reason being that I think being short the stock market is will make lesser gains percent-wise than will being long the monetary metals. I'd rather be long the other side of that situation because I think the percent gains will be far greater than any decline in the stock market. But the stock market is a factor because it's a factor for the central banks.
Silver isn't just another shiny metal anymore. It's becoming one of the most critical resources of the 21st century. And that dual role as both a precious and industrial asset is creating a perfect storm for an explosive price move. On the monetary side, silver is surging back into favor as investors seek shelter from currency debasement, inflation, and rising geopolitical risks. But it's the industrial demand that's quietly rewriting the silver story entirely. From solar panels and electric vehicles to 5G technology and medical applications, silver is no longer optional. It's essential. The green energy revolution alone is devouring record amounts of silver. And with governments worldwide pushing for net zero emissions, that demand is only going to accelerate. Unlike gold, which is hoarded and stored, silver is consumed, used up, and often lost forever in the products it powers. That means every ounce that's mined and then used is one less ounce available for investment when the next buying frenzy hits. And with demand skyrocketing while new supply struggles to keep pace, silver is setting up for a historic supply and demand imbalance, one that could send prices soaring faster and harder than almost anyone expects.
Well, actually, during most of that 12-month period, we started March of last year, so it's been a full year of upside. But really, it wasn't vertical. It was a lot of, like I said, laborious 3 steps up, 1 step back, go to sleep for 3, 4, 5 months. That process. It's only in the last few months that it's really gone what you would call vertical. In fact, you can even see it on price charts now. Momentum did it first, and then price, you could draw a line across the last year or so of upside, and there's like a rising line across the highs, and we popped through that a month ago, and we're still above that level, that acceleration level on price. So I think the acceleration in gold has just begun. But when you flip over to silver, they've been caught in a range with a high at 33 back in October of last year, and then a drop. And then they went to, that was May of last year, and dropped. Then in October of last year, they went up to 35 and then dropped again, but it was a higher high. And then this March, they went up to 35 again and dropped and cleaned everything out. And now we're trading in the 32, 33 zone. When we we do a momentum study of that price action, which you could draw a line. You go back to May of last year. It was a year ago, 13 months ago, and draw a horizontal line across the highs that we saw back in May of last year. You're diddle-dawdling on either side of that line. So silver's really not breaking down, but it is stalled with a horizontal line going through the ink over the last year, where it goes above it and below it, above and below it. But momentum during that time, long-term momentum, has had a corrective tubular decline. Price is horizontal, basically. Momentum, it's been a parallel channel that goes back a year. And whenever momentum develops something that clear, I define it with my hands here, but it's like a channel of action on momentum, but it's very old now. It's 1 year old of this process of correcting from overbought levels. Price has only gone sideways, net on balance, while momentum has had its full correction. You break out of that channel again on momentum, and you'll do it up around the 34.35 level using the front month silver, which is now July future. You go back up to those highs again in price, momentum will be breaking out of this massive channel. In other words, momentum will be saying, pounding the table, I'm starting again. So though it's been wild but boring for the last year on price, momentum has cooled off to the point where it's created a structure that if you break out of it, you're going to gush on the upside. And so what we're arguing is we think they've had a year of time to go ahead and kill it, but they couldn't. Instead, you've oscillated either side of 33 with two peaks at 35. So we think that the momentum picture says, no, it's too old. You're not going down. You've been going down for a year. You're ready to turn and go the other way. So I think the real shocker here will be silver, not so much gold. Yes, gold has gone into price acceleration, while silver's built this pattern on momentum that says, I haven't even begun.
Gold has been quietly laying the foundation for silver's next big move, and the signs couldn't be clearer. After a breathtaking rally that saw it test and flirt with all-time highs, gold has entered a classic consolidation phase. Not a breakdown, but a powerful setup. Right now, gold futures are holding steady between $3,200 and $3,500, a range that veteran traders recognize as a textbook launchpad for the next major breakout. And when gold breaks decisively above resistance, especially with volume and conviction, silver historically doesn't just rise in sympathy, it explodes in response. In every major bull run of the past, gold's surge was the spark, but silver was the fuel that created the wildfire. This moment of calm in the gold market isn't a warning to stay away. It's the quiet before the storm. The moment when smart investors position themselves ahead of the crowd. Because when gold finally roars past $3,500 and heads toward $4,000, silver will almost certainly unleash the kind of violent slingshot rally that turns patient positioning into legendary returns.
If you go back 50 years and look at the silver divided into the price of gold expressed as a percent, 1% is super low. So in other words, either it's going to hell and going to zero, okay, which isn't going to happen, or you're looking at a bargain. Because anytime silver gets down to 1% of the price of gold, look out the next 6 months or so and you'll see drama. Okay. In fact, this happened. It got down to 0.8% the price of gold in that COVID sell-off. And in the next 6 months, silver went off the page percent-wise. While gold had a nice, 40-50% move, silver doubled in that 6 months. There is, when you plot the spread relationship, not just the spread itself as a chart, we also run momentum of the spread. And what we're saying is that spread now has gotten bound below the 1% level, and it's just marginally below it right now as we speak. You get back above about 1.1%. That sounds trivial, but when you divide this over into gold and you see it get up, have a weekly close at 1.1% or higher, it's a boarding out of this hole, and it's saying, I'm coming out of here again. And there's another level up at 1.3% of the price of gold, that if you go through that, the lid will come off. You'll gush to 2% in a heartbeat. Well, you say, 1% to 2, who cares? Well, that's a doubling of the value of silver versus gold. It's like buying something at 1 and it goes to 2, okay? So we're keenly watching the silver-gold relationship, because when that breaks out, it's never a situation that you have that gold is going down more than silver and silver's holding, and therefore silver's appreciating versus gold by not going down as much. It's always a situation where silver's going up much more than gold. So it's always bullish when silver-gold situation shifts into positive.
While the Western media stays mostly silent, a tidal wave of global buying, led by Chinese investors, is quietly flooding into silver, setting the stage for an explosive breakout. In China, demand for silver-backed ETFs has surged dramatically following the end of their extended Labor Day holiday, with retail investors and institutions alike pouring into the metal as both a safe haven and an industrial powerhouse. This isn't just speculative frenzy either. It's a calculated move in response to rising geopolitical tensions, weakening fiat currencies, and a global economy teetering on the edge of uncertainty. Chinese investors have historically been early indicators for major moves in the precious metals market, and their aggressive accumulation of silver right now sends a crystal clear signal to anyone paying attention. Meanwhile, across the rest of the world, more investors are waking up to silver's irreplaceable role in the Green Revolution and its unmatched potential as a monetary asset. This swelling global demand is coming at the exact moment when silver supply is under maximum pressure. And when those two forces collide, history shows that silver doesn't rise steadily, it erupts.
It's an interesting factor. Gold's been going up for over a decade. And now in the last year, suddenly we have this China situation where everybody has turned their focus like China's buying, China's buying, China's buying. And they like try to report on it every week. How much did they buy? And in the other, we understand that just recently there was 1 million ounces sold, which isn't that much, in the bigger scheme of things, from Chinese, probably citizens, not the central bank necessarily. And everybody thinks that's all you get to watch. No, it's not. Gold moves on far broader trends in monetary degradation globally, not just U.S. money degradation, but global. I saw a report the other day that global money supply has gone up 200% over the last 15 years. 200%. Okay, meaning the quantity of money has gone up, therefore the purchasing power, the real buying power of those money units has declined. And for the dollar, going back to the 1950s, every single decade, look at M2 and see it went from here to here, do the percent, and you'll see that it almost doubles every decade. And even more so recently because of what happened with COVID. Also, since the 2009 bear low, they did QEs. Don't be shocked if they go back and do QEs again. And by the way, the other thing I would be looking at in terms of what's the Fed going to do is not just the data points, the economic data points, because they're going to go sour big with the stock market. They follow the market. They don't lead the market down. Is the T-bond market. Something's wrong over there. Treasury bonds are normally another alternative place to put your money if the stock market is in trouble. And yet, since the stock market dropped 20% from January to April, and now has bounced, but the bonds haven't risen. They've tried repeatedly to rise in price, drop in yield. I'm talking 30-year bond futures, for example, not the short end of the market that the Fed controls, but the long end of the U.S. government debt market. It's a dog. Now, we even thought technically there was justification for T-bonds to participate with gold as an alternative to the...
Beneath silver's calm surface lies one of the most explosive setups in the entire financial system. Years of quiet price manipulation and short selling have built a powder keg, just waiting for a spark. Major banks and institutional players have spent years heavily shorting silver, using paper contracts to suppress its price and maintain the illusion of abundance. But here's the problem. With physical silver supplies tightening and real demand soaring, the paper promises are starting to look dangerously hollow. When too many investors demand delivery of real, tangible silver at once, and the exchanges can't meet that demand, the result isn't orderly, it's chaos. Forced buybacks, margin calls, and a scrambling short covering frenzy could send silver prices rocketing in a matter of days, not months. We've seen glimpses of this before during past silver squeezes, but this time, the stakes are even higher. The underlying physical market is thinner, the global demand is stronger, and the public's distrust of financial institutions has never been greater. When the dam finally breaks, it won't just be a rally, it could be a historic repricing of silver as the true fundamentals overwhelm the years of artificial suppression.
A fractured stock market. And we saw a nice surge. Back early this month, T-bonds shot up to 122 on the T-bond futures from lows down in the mid, one teens, 115, 114, etc. So there was a big surge in price and a drop in yields, but it crashed. T-bonds in 2.5 days went from 122 in price to 111. For T-bonds, that's a crash. That kind of percent drop, especially in 2.5 trading days. And since then, they bounced back up about halfway to that 122 high. And I think the best we've seen is about 117 or so. Right now, we're trading the 115s. I think even today, we traded under 115. So the T-bonds are lame. They're not functioning as they normally do as an alternative place for money managers to shift some money to avoid risk in the stock market. What's going on there? That is of great concern to the central bank and to the government itself. So don't just look at the data points. If that T-bond market doesn't start to behave, in a healthy manner, and especially if the stock market starts to go down again and you don't see bonds go up, whoa, what's going on there? Well, we know what's going on. The big fundamental is we have a government debt crisis. The question is, when is it going to occur? And right now, T-bonds in the high 114s, you don't want to ever see the nearby futures. It would be the June T-bonds right now, down at 111.5 again. We argue you close a month down there, they're going to flush them. Well, that's what will panic the Fed more than will the stock market. So watch the T-bonds. And the dollar as well, which is a crippled bear market as far as we're concerned.
All of the signs are converging right now into one of the clearest setups the silver market has ever seen. The collapsing gold-to-silver ratio is flashing a historic buy signal. Trade optimism is breathing new life into commodities. Industrial demand is skyrocketing with no signs of slowing. Supply chains are straining under relentless pressure, and gold itself is quietly setting the stage for an explosive next move. Meanwhile, global buying, particularly from Chinese investors, is surging beneath the radar, and the heavily shorted silver market is teetering like a house of cards. This isn't just one bullish factor lining up for silver. It's every bullish factor all at once, and the window to position before liftoff is closing faster than most realize. In past cycles, when silver moved, it didn't politely announce its rally in advance. It erupted with a violence that left hesitant investors watching helplessly from the sidelines. Today's setup isn't just similar to those past explosions. In many ways, it's even stronger. This time, silver isn't just following gold's lead. It's poised to outperform dramatically, offering the kind of asymmetric upside that only comes around a few times in a generation.
The banks are sort of secondary to the borrowers. One of the big borrowers is the commercial real estate market. And there's some ETFs that cover that, RWR and VNQ. And if you look at them going back 10 years or so, they didn't participate in that recent stock market surge that took out the 2022 price highs. For S&P, that was 4,800. We went up to 6,200. But VNQ and RWR, they didn't go anywhere near back to the highs. So, yeah, they were trying to rally during that time, along with the stock market, but they were anemic as heck. And they started to roll over again, like the market. We had an instance about 3 weeks ago where I think the largest shopping center in the U.S. had a $300 million debt default. Headline came and went. But that's the kind of stuff that's built into this commercial real estate market, as I understand. I don't look at its fundamentals, but I hear this from many analysts that there's a lot of debt there that's coming due soon, and a lot of them are in trouble. And therefore, if that starts to become a trouble zone, it will impact banks. And so watch both those sectors. They're more anemic than the stock market. They've had less of a bounce than the stock market. So No, they're going to go with the stock market. So if the stock market rolls over, watch the banks. Right now, the KBE, for example, which is a bank ETF, I think it's trading just above 150, like 151, or is it 51? I'm sorry. But it made a recent low of 45. And if you go back down to 47 again, not even back to that low, watch out. You don't even want to approach that low we saw early last month, which was 45 area. You don't want to go to 47. So about, 4 points below where you are right now, I think it's 51. You go back down to 47, watch out. But again, that's going to be a function probably of some other arena having debt problems that, of course, ricochet into the banks. And that'll be a headline factor at that point again, Right now, banks aren't a headline factor. Instead, we're looking at NVIDIA and Apple and stuff like that. Got to watch these other markets, those other sectors. Well, we look at all the four major asset categories: stock market, debt markets, not just U.S. stock market, others as well. And there are a couple that are in sync with us, by the way, in a negative way. Commodities broadly, foreign exchange, and right now it's suddenly become an active mover. For a couple of years now, the dollar index, and then meaning the euro and the yen, were in a narrow range. The dollar index was like in a 7% range for a couple of years, which is nothing. It wasn't causing impact in the other markets. Now suddenly it is, because it's entered a bear market now. And so suddenly it's become a player again. So we watch Forex and the emphasis on gold and silver.
Everything we've discussed points to one unavoidable conclusion. Silver's 100% surge isn't a fantasy. It's a freight train that's already picking up speed. The collapsing gold to silver ratio, the surging global demand, the tightening supply, and the systemic cracks beneath the surface of the market are aligning into a perfect storm. When silver moves, it moves fast, and by the time the headlines start flashing, it will already be too late to catch the liftoff. This is a historic moment in the making, one that smart investors will look back on as the opportunity of a lifetime. So if you see what's unfolding, stay sharp, stay prepared, and don't get left behind. Make sure to subscribe for more insights that could help you stay ahead of the curve. And remember, this is not financial advice. Always speak to a qualified professional before making any financial decisions.